There is no economic tsunami coming. It's a relentless rising tide. And when you look back, you go, oh my God, it's gone up further and further and further. Everyone waiting for the tsunami, if we didn't get it in March 2020, we're never going to have it at all. So you have to realize that there's something different.
The developing world is on the brink of a devastating economic crisis, and unfortunately, many poor countries are ill-prepared to handle the far-reaching consequences that will follow. The impact will be felt not only in terms of finances, but also in society and politics. Imagine a life where everyday essentials like fuel and medicine become scarce, where electricity is shut down due to exorbitant costs, and where rising food prices devour a significant portion of meager incomes. In such dire circumstances, it only takes a small spark to ignite widespread discontent. Sri Lanka serves as a visible example of how swiftly an economic crisis can lead to the collapse of society. However, similar sporadic protests are erupting in numerous countries where governments are grappling with the difficult task of balancing the expectations of their people with harsh financial realities. Given the imminent economic depression, experts in macroeconomics and market strategy are diligently predicting which assets can act as a safeguard against hyperinflation and soaring prices, especially for essential goods like food. While bartering and trading are likely to regain prominence, many believe that gold, a traditional safe haven asset, will significantly increase in value compared to its current worth. Additionally, some analysts argue that cryptocurrencies, with a total market value of over $2 trillion today, could serve as an alternative safe haven asset, providing refuge for those seeking to escape the impending financial storm. Furthermore, Raoul and Yusko sheds more light on the worsening economic times and how these developments will impact the younger generation. As you watch the video, kindly support his content by liking the video, subscribing to this channel, and dropping your comments below.
So let me put it in the perspective for others to understand what this means. A millennial and a boomer, father and son. The father, when he was 30 years old, was probably, it was about 1980, 81. Then they had record low valuations for the stock market, a P of 7. Record high interest rates, so he saved money to stick it in bonds, made 18% or 15%. Record high credit on corporate debt and really cheap property. So the baby boomer had this huge set of opportunities ahead of him. And gold was pretty cheap too, but was going up quite rapidly. So when you look at the percentage of those assets that they could buy with their wages, we get a number. Cut forward to the son, 32 years old, 2021. They can buy 60% less in property than their parents could for the same median wage. They can buy a lot less of the S&P, a lot less gold. So what are those things? Those are assets. The price of milk must be about the same, but it's the assets. Why assets count is assets are where you save. Those are the things you own that go up in the future and you release the money from, and that's your return on investment. But a young person now can make a lot less investments than their parents could. That is what is going on slowly over time. Your share is becoming less. And that is what's driving the rich-poor divide, because the rich all get access to this free money and can buy more of these assets that go up. The more they go up, the richer they get. The guy on the median income who's 32 years old can't own any of that stuff. It all really started around 2000 when that bubble popped. The Federal Reserve decided that the only way forward was to use interest rates to drive kind of demand. And it was a massive debt boom that followed. That debt boom, as we know, blew up in 2008. And for many of us in the macro world, that was something that we could see. It was pretty obvious it was going to happen. I was one of the people at the core of that, predicting what's going on. And many of the famous people in the Big Short were kind of subscribers of my research service, the Global Macro Investor. We kind of all knew it was happening, but people in the street didn't. So people would come up to me and say, well, why don't we know? And I realized that that information hadn't really got out there. And I realized that I had access to information other people didn't have. And it wasn't fair. And after Occupy Wall Street, the rise of populism, you knew that the power had to be given to the people. The democratization of information was vital. After 2008, I realized that the problems hadn't gone away. The same problems were there, and all the central bank had done was generate more debt by generating lower interest rates, and now they'd started quantitative easing, which is basically the printing of money to try and hide those debts. And it became clear to many of us that the next recession was going to be a big problem. If 2008 was bad, the debt burden was getting bigger and bigger and bigger, so something bad was going to break.
The periodically repeated U.S. debt crisis severely dented its image as a world superpower, prompting a question that whether the hegemony of the U.S. dollar overrides global stability. Putting the financial policymaking in the hands of polarized politicians not only harms America, but also sounds alarm bells about the U.S. shaking position in maintaining the global economic stability, an expert points out. Instead of resolving the debt problem itself, the United States has been exporting its domestic crisis to other countries by taking advantage of dollar dominance, according to the expert. Mark Yusko, founder, chief investment officer, and managing director of Morgan Creek, shares his view on the economic situation and how Bitcoin solved that problem.
The average price of gas that I put in my car was 31 cents. Now, I visited my son here over the weekend, and to get a gallon of gas now here is $4.31. It's the same gallon of gas. It does the exact same thing. In fact, arguably it's a little less good because now it has some ethanol in it, so it's not quite as combustible as it used to be. The gas hasn't changed in that 40 years. What's changed is the currency is less valuable. And part of the story of Bitcoin is that as well. Is when we talk about Bitcoin, we don't talk about Bitcoin in isolation. We talk about Bitcoin priced in dollars. When we talk about the stock market, we don't talk about the stock market price in isolation. We talk about it priced in dollars. So when the nominal value of something increases, sometimes it's not because the value of that asset is rising, it's that the value of the currency you're denominating it is falling. And so it's that subtle, slow, again, theft. And what's really interesting is it's like the tail of the boiled frog, right? If you drop a frog in hot water, it will jump right out. But if you put it in cold water and slowly turn up the heat, its muscles will relax to the point where when it gets to the boiling point, it won't be able to jump out. And that's kind of what happens with this slow, insidious devaluation of the currency. So again, the government job is to extract the wealth from the people that create the wealth, the labor, and they do that through this tax of inflation. Governments will always profligately spend, right? That's what governments do best, is they spend money. And empires rise, governments become more and more powerful, they become more and more concentrated at the top with their cronies, and then empires get so indebted that they have four choices. They can pay the debt back, they can restructure it, they can default on it, or they can devalue it. Well, they can't pay it back because there's not enough revenues, kind of like today, where we're seeing the budget deficit widen and widen and widen. They could restructure it. Well, who's going to take the deal? No one. Okay? They could default on it. Well, if you do that, then you get kicked out, so they can't do that. So the only choice is to devalue. And when you devalue, eventually you devalue so far that the empire fails, right? The Roman Empire, the Ottoman Empire, the British Empire, every empire. And now we're seeing that happen, I believe, in the American Empire, which is causing this great stress on the monetary system, which is what I believe led to the creation of Bitcoin as a cryptocurrency, different from a fiat currency, because a cryptocurrency has a finite supply, different from a fiat currency, which can be created at will.
The World Bank warned that the global economy is in a precarious position as it predicted slow growth this year and cut its forecast for next year. The organization predicted in its Global Economic Prospects report that worldwide gross domestic product, GDP, would rise 2.3% this year, higher than its January forecast of up 1.7%, but well below last year's 3.1% gain. For 2024, it lowered its estimate to an increase of 2.4% from 2.7%. The report indicated that economic expansion in developed countries would decelerate to 0.7% this year from 2.6% in 2022 and remain weak in 2024. It said the U.S. would go from a 1.1% advance in 2023 to just up 0.8% next year. The World Bank blamed that mainly on the sharp rise in interest rates in the past year and a half. Emerging markets and developing economies, EMDE, other than China, are set to have growth of 2.9%, down from 4.1% last year. It noted those countries are feeling the overlapping shocks of the COVID-19 pandemic, the war in Ukraine, and the sharp slowdown amid tight global financial conditions. Indermit Gill, the World Bank's chief economist and senior vice president, explained that even by the end of 2024, one-third of the developing world won't have per capita income levels as high as at the end of 2019 before the pandemic. He said that's 5 lost years for nearly a third of the world's countries. The world seems to be gearing up for a very turbulent time. What moves have you made to ensure you are not caught up in the ruse? We would like to know your opinions in the comment section below. Also, don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.